Good afternoon, everyone. I have great pleasure in welcoming you all to Grand Thornton Bharat's webinar on the new reassessment regime, recent developments and issues. As you may all be aware that the Finance Act of 2021 introduced a new reassessment regime from 1st April 2021. Then came in extension of various timelines by the government, which was done as a COVID relief measure. But these extensions also triggered a controversy on issue of reassessment notices by the tax department under the old regime, even when the new reassessment regime was operational. The Supreme Court has recently settled this controversy. However, while this decision is being implemented, there are still several challenges being faced by the taxpayers. Today, we will be discussing and deliberating on the broad contours of the new reassessment regime, the Apex Court's decision, and the issues and challenges that are being faced or likely to be faced by the taxpayers from a practical perspective. I have now great pleasure to introduce our panelists for this session. We have senior advocate Mr. Ajay Vora with us today. Mr. Vora doesn't need introductions. He's a qualified chartered accountant and lawyer and has been practicing for over 37 years in the area of domestic and international tax. He is a leading arguing counsel before tax tribunals, high courts, and the Supreme Court, and has argued several cases involving complex issues having wide ramifications, which have contributed immensely to the tax jurisprudence in the country. Welcome, Mr. Vora. Next, we have Mr. Thank you. Next, we have Mr. Riaz Thingna, who is a chartered accountant having over 30 years of experience in tax and regulatory matters. Riaz will be moderating today's panel discussion. Welcome, Riaz.
Thank you. Thank you.
We have then Mr. Hunaid Contractor, who is a chartered accountant having over 30 years of experience on tax and particularly tax litigation matters. And his areas of expertise, therefore, are directly important for us to kind of listen into this particular conversation. Welcome, Hunaid.
Thank you, Shreya.
Lastly, we have Richa Sahani, who is a chartered accountant with over 25 years of experience, particularly on income tax and particularly on involved issues on tax matters. Welcome, Richa.
Thank you, Sridhar.
Let me now hand over the session to Richa, who will take us through some of the key features of the new assessment regime, new reassessment regime, and the key takeaways of the Supreme Court decision, including the CBDT circular issued to implement this decision. Some hygiene, as usual, requesting the audience to use the Q&A box to raise their queries, and we will try to take these up during the course of our discussions or answer them subsequently directly to you. Richa, over to you.
Thank you, Sridhar. Yeah. Good afternoon, everyone. Let's begin with the key features of the new reassessment regime. Now, Finance Act 2021, it introduced a new reassessment regime, which was effective from 1st April 2021. It substituted the existing reassessment provision, and that is section 147, 148, 149, and section 151, and also introduced a new section, that is section 148A. Some further tweaking was then done by Finance Act 2022. Now, these changes were made with an objective to completely revamp the reassessment regime in India and to introduce new procedures for reassessment. And the objective was to reduce litigation and provide ease of doing business in India. Now, under the old regime, if the assessing officer had reason to believe that any income chargeable to tax has escaped assessment for any assessment year, he could reassess the total income for that year by issuing notice under section 148 of the Act. Reassessment was guided by the principle laid down by the Supreme Court in the case of GK and drive shafts, which very broadly meant that the ROI had to be filed, or the return had to be filed by the taxpayer in response to the notice, and the taxpayer could seek reasons for reopening the assessment. The tax officer was bound to furnish reasons for reopening. Taxpayer was entitled to file objections. Speaking order was then required to be furnished by the tax officer, which disposed of the objection, and then he could continue with and complete the reassessment exercise. Now, under the new regime, no notice under Section 148 can be issued without complying with the procedures laid down by Section 148A. Now, let's see how Section 148A works. What this section mandates is conducting an inquiry by the assessing officer with respect to information which suggests that income chargeable to tax has escaped assessment. A show cause notice is issued at this stage, and an opportunity of being heard is provided to the taxpayer. Now, the taxpayer is supposed to file its response within stipulated time frame, which ranges from 7 to 30 days, and extension is also feasible here. On receiving the response from the taxpayer, the AO has to decide, basis the material available and the response, whether at all it is the case fit for issuing notice under Section 148 of the Act. And this is done by an order passed with the approval of the specified authority. This is to be done within 1 month of the receipt of reply from the taxpayer. Now, some carve-outs are provided where this process is not required to be followed, and these are cases of search, survey, and requisition cases. Now, let's see what is meant by the term information that suggests income chargeable to tax has escaped assessment. Now, as you've seen, this term has been used both in Section 148 and 148A. And for the purpose of these two sections, the Act says that it implies information which is in accordance with the risk management strategy formulated by the board. Now, Finance Act 2021 referred to information flagged in accordance with the risk management. This term flagged was dropped by Finance Act 2022. The second, any audit objection to the effect that assessment has not been made in accordance with the provisions of the Act. Here again, Finance Act had talked about final objection raised by the CAG. However, Finance Act 2022 modified this to make it any audit objection. Then we have any information received from a foreign jurisdiction under an agreement. This could be a tax treaty, and any information collected through the faceless collection of information scheme. And last, we have information which requires action in consequence of an order of a tribunal or a court. Now, as far as search, survey, and requisition cases initiated after 1st April 2021 are concerned, it is deemed that the assessing officer has information which suggests that income chargeable to tax has escaped assessment. So here a deeming fiction has been provided. Moving on to the timelines. Now, in general, a notice can be issued up to 3 years from the end of the relevant assessment year as far as the new reassessment regime is concerned. However, this can be stretched up to 10 years if the AO has in his possession either books of accounts or documents or evidence which suggests that income escaping assessment is represented in the form of either an asset, an expenditure for a transaction or an event or an occasion, or entry in the books of accounts, and which is in excess of 50 lakh. Now, this term asset has been defined to mean any immovable property. It could be land or building or both, shares or securities, loans and advances, and even deposits in banks. In addition, there are grandfathering provisions as far as AY 2021 and the prior years are concerned, and no notice can be issued under Section 148 for these years if it could not be issued at that time on account of being time barred under the old regime. So the net impact is that for these years, 10 years has to be read as 6 years. Now let's talk about the recent dispute on this area and how it evolved. Now, on account of the pandemic, the government extended various timelines, and the last date of reassessment notice, issuing reassessment notice, was also extended from 31st March 2021 to 30th June 2021. So accordingly, Relying on these notifications, the tax department continued to issue reassessment notices under the old regime even after 1st April 2021. So in nutshell, there was an overlap of the old regime and the new regime during this particular period. During this period, more than 90,000 reassessment notices were issued. Writ petitions were then filed before various high courts across the country challenging the validity of these notices. And in many cases, high courts quashed these reassessment notices on the ground that they were bad in law. That is, the reassessment notices issued after 1st April till 30th June were to be governed by the new regime put in place by Finance Act 2021. This controversy traveled to the Supreme Court, which has been recently resolved in the case of Ashish Agarwal, where it has been held that where the Supreme Court had basically agreed with the view taken by various high courts and held that the benefit of the new reassessment provision should be made available in respect of reassessment notices issued after 1st April. It said that these provisions are remedial and benevolent in nature, and therefore this benefit needs to be extended. Now, quashing of these reassessment proceedings by the High Court would have made the tax department remediless in many cases. So, in order to strike a balance between the rights of the taxpayers and the tax authorities, the court tried to travel on a different path. It said that these notices have been issued by the tax department under a bona fide belief that the new regime may not have been enforced. So it modified the judgments as follows. The notices issued under the old regime are deemed to have been issued under the new regime, and they will be treated as show cause notices under the new regime. The tax officers are required to provide all the information and material relied upon them while issuing these notices within 30 days of the court order. Taxpayers can file their responses within the prescribed timelines, which is 2 weeks. The requirement of conducting a prior inquiry has been dispensed with as a one-time measure. Thereafter, the tax officers will pass the orders after following due procedures. The court has also laid down that all defenses which may be available with the taxpayer under the new regime and the related rights of tax department will continue to be available. This decision has pan-India ramifications and will substitute and modify orders passed by high courts, whether or not they have been challenged before the Supreme Court. This has been done to reduce the spree of writs before the Supreme Court. Post this, to give effect to the Supreme Court decision and to ensure uniform implementation, CBDT issued instruction number 1 of 2022, giving directional guidance to the tax officer. This instruction clarified yet again that the Supreme Court decision applies to all the cases, whether they have been challenged or not, and guidance in respect of various assessment years has also been provided. While this instruction clarifies a lot of points, yet taxpayers are still facing challenges in the implementation phase of the apex court decision. To discuss these issues and some other key aspects of the new regime, I will now hand over to Riaz. Over to you, Riaz.
Thank you. Thank you, Sridhar, for introducing the panel so generously, and Richa for setting the context so succinctly. And a very, very warm welcome to all the participants. So coming to the topic on hand today, as you are aware and how Richa briefly mentioned, the amended provisions of the new assessment regime were designed to reduce litigation. But as it happens with all changes, many questions were raised and many controversies erupted on various issues. Of course, the Supreme Court has taken one part of it under its control to end the controversy, that is the around validity of reassessment notices, and giving more time to the revenue authorities to comply with the new procedural requirements. But many questions remain unanswered. And today we'll discuss some of them with our extremely knowledgeable and august panelists. So without much ado, let's straight away jump into the issues. We'll start with you, Mr. Vora. And I'll start with the most commonly asked question. Section 148A refers to information which suggests that the income chargeable to tax has escaped assessment. So my question is, how is the term to be construed? Is it similar to reason to believe? Do we understand, on the other hand, that the concept of reason to believe is no longer relevant under the new regime? Yes, Mr.
So, Riaz, if you permit me, before I answer your question, I must start with a disclaimer. And a disclaimer on behalf of not only myself, but all the other panelists. Friends, I can tell you that we don't have ready-made answers to all your questions. As Riaz said, the Supreme Court has used Article 142 in order to set at rest the controversy, but it leaves many questions unanswered. One had expected the Central Board of Direct Taxes, when they issued the circular, to clear the air on many of the issues. But unfortunately and sadly, the circular also does not throw much light. So I expect substantial litigation to be generated in the days to come with respect to implementation of the Supreme Court directions for the reopening of assessments. So now to come to your point, I think the Finance Act 2021, when it made the changes, the intent was, and that was a laudable intent, to cut down on litigation and to impart finality to concluded assessments. That's why the time limit was reduced from 6 years to 3 years. And the enlarged limit of 6 years was available only in certain specified kind of cases. So therefore, the threshold was lower, the bar was lower. And I would think, that's my personal opinion, that the word suggests escapement of income is probably lower in degree compared to reason to believe. But having said that, suggest escapement of income is only in cases where you seek to invoke the extended time limit. And that must be basis information, which is defined in that explanation 1 to section 48. So to my mind, the definition of the word information is exhaustive. I don't think you can travel beyond what has been enumerated as instances of information which suggest escapement of income. So the information must be married with the facts of a particular case to say and come to the conclusion that income of that particular assessee has escaped assessment before you can assume jurisdiction under section 148. I hope I have articulated the point to your satisfaction.
No, absolutely. Thank you very much, Mr. Bharat. As usual, you have articulated very, very clearly. But just as a follow-up question, so, in the explanation, we also have that there's a reference that the information is flagged in the case of the assessee should be in accordance with the risk management strategy formulated by the board. Now, does that mean that the taxpayer is well within his rights to ask for a risk management strategy and also question how anything which is flagged suggests that income has escaped assessment? Would that right remain with the taxpayer?
I would think that the risk management strategy is probably an internal document. Maybe confidential, at least I'm not aware whether this has been shared in any case. So I would assume that the department may not share the risk management strategy per se, but if in a given case, the assessee is to challenge this in a constitutional court, to say that what is the information and how does it deal or how is it part of the risk management strategy, the court may be well inclined to direct the department to produce that particular document. And then the question about income escaping assessment, so the risk management strategy is only suggested. Thereafter, it must be shown with reference to the facts of that case, that basis the risk management strategy or basis what is flagged, the income of the assessee has escaped assessment in a particular manner. I think both the limbs need to be clearly satisfied.
Great. So there is scope for further litigation on at least the risk management and the rights of the assessee to ask for those documents. Coming to you, Hunaid, the term Mr. Vora also referred to the term of information as explained in the explanation to section 148. In your view, is this definition inclusive or exhaustive?
The explanation 1 to 148 reads that information means, and then those 5 instances are listed down. To my mind, when the legislature has used the term means, then as Mr. Vora also said, it is exhaustive. On the other hand, like for instance in section 224, while defining income, they have used the term income includes. So income is denotes an extension of the term, and it cannot be restricted. But in this case, when they've used the term information means, and then they've listed down those 5 instances, then it has to be read only with respect to what is laid down in those 5 cases.
So it's exhaustive. Thank you, Anay, for coming. Coming back to you, Mr. Vora, section 149 specifies inter alia that a notice under section 148 shall not be issued unless the income chargeable to tax represented in the form of an asset has escaped assessment. Now, what is meant by the term represented in form of an asset as stipulated in the section 149? Whether any asset forming part of the financial statements prepared by the taxpayer could be covered under the purview of the above provisions to mean it is a form of asset?
Riaz, I would want you to step back.
Yeah.
Look at the opening part of the section where the extended limit is available. That the assessing officer has in his possession books of accounts, document or other evidence, which, and then it follows, which is represented in the form of an asset, an entry, or things of that kind. I would lay emphasis on the words has in his possession books of accounts. Now, this provision is applicable only when you seek to invoke the extended time limit. And in my understanding, these account books are other than your regular books of accounts. It is not that the assessing officer can seek to reappraise what is already recorded in your regular books of accounts and say that this is suggestive of income escaping assessment, and this is represented, let us say, in the form of shares in your duly reflected in your regular books of accounts in your balance sheet, and therefore I seek to invoke jurisdiction to reopen your assessment. I would think in times to come, the courts need to give due emphasis to the words has in his possession books of accounts. And if you look at the budget speech of the finance minister while moving the finance bill 2021, it was referred to as the undisclosed income. So the undisclosed income would suggest that this is outside your normal books of accounts. It is only in those kind of cases that you can invoke this jurisdiction. I saw recently, there was a case from Allahabad High Court, where the Allahabad High Court struck down the reassessment on the ground that the income escaping assessment was less than 50 lakhs. So they said the extended 6 years limitation is not available. But this was not argued that the assessing officer does not have in his possession any books of accounts, evidence or document suggesting escapement of income which is represented in the form of an asset. Take for instance an example of a foreign company. Now a foreign company has not paid tax on the bona fide belief that the income is not chargeable to tax in India. Can you say that this payment that they receive from the Indian company or an Indian entity on which they have not paid tax on the basis it is not liable to tax in India is reflected in their balance sheet in the form of cash, bank balance or whatever? Can you say that merely because they have not filed a return basis their understanding that income is not chargeable to tax in India and this is reflected in their balance sheet? So it is income escaping assessment represented in the form of an asset and hence we invoke the 6-year limitation. To my mind, the answer is clearly no. I will definitely wait to argue this proposition in any court.
Absolutely, because this could otherwise have the result of being applied too widely, and we really wouldn't know.
Then you are almost saying that on a change of opinion, on reappraisal of the existing material, you can invoke the enlarged limitation. That's clearly against the legislative intent.
Oh, that's a very valid point you raised, because you spoke about change of opinion. So in view of the amended provisions, is it incumbent for the revenue to demonstrate that the income has escaped tax, or will it be construed as change of opinion? Because if it gets, and on the other hand, if it is covered in the explanation 1 to section 148, then will a plea of change of opinion become absolutely futile? So
See, I would look at it in two ways. Again, as we said in the beginning, clearly there are no clear-cut answers to this issue. As I see it, change of opinion probably cannot be read into the amended provisions, because the word used suggests income escaping assessment. So reason to believe, which was there in the old law, and if you look at the Kelvinator judgment, the Supreme Court took note of the fact that originally in the finance bill, these words were not there. It was said opinion of the assessing officer. And when the act was passed, it was changed to reason to believe. So the Supreme Court said that clearly change of opinion would not justify a reopening. Now, when the threshold is reduced to 3 years, in my view, the assessing officer will be entitled on reappraisal of the existing material to come to a different conclusion. But so therefore, it may be possible for the assessing officer to say that I have had a relook, and therefore, on my understanding, this is suggestive of income escaping assessment. This is one aspect. Look at it the other way. Suppose you have the extended 6 year limitation. The definition of information.
right.
The definition of information says that any consequence to be taken, any action to be taken in consequence of a decision of the Supreme Court, High Court, or the tribunal. Now, under the old law, if you had made full disclosure, notwithstanding that subsequently a court took a different view, it was held that reassessment is barred if it was within the terms of the first proviso to section 147, because there was no failure on your part, notwithstanding a later decision adverse to the assessor. Now here, information is any action to be taken in consequence of any decision of the Supreme Court, tribunal, or otherwise. Now, on that basis, can the assessing officer, on a change of opinion, he may have taken a view in favor of the assessee, but here there is an adverse view. So can he assume jurisdiction? Again, is an open question. To my mind, the language of the section seems to suggest yes, he can, and therefore change of opinion may not be relevant under the amended provisions.
Great. Thank you. Thank you very much, Mr. Vora. Now, coming to the specific issues arising out of the Supreme Court ruling, let me start with Hugh Sridhar. Whether the reassessment proceedings, that is under section 148, 149, 148A, as amended by the Finance Act 2022 or the Finance Act 2021 need to be considered for notices which have been issued pursuant to the Supreme Court judgment. So primarily notices which have been issued post 1/4/21 before 30th June 21. Yeah.
Yeah, thanks, Riyaz. So para 8 of the Supreme Court decision says that notices under the old section 148 issued to SSC shall be deemed to have been issued under section 148A as substituted by the Finance Act of 2021 and treated to be show cause notices in terms of section 148 subclause B. I'd like to point out that the Supreme Court order issued under the constitutional powers under Article 142 only provides for deeming of the notices issued earlier during the period between 1st April 21 to 30th June 2021 as having been issued under 148A subclause B of the Act. It does not seem to provide that the notices will be deemed to have been issued as on 4th May 2022. Therefore, it seems to be logical to say that the same should be governed by the provisions of section 148, 148A or 149 as existing on the date of the issue. That is based on the law as it stood at the point of time after amendments by the Finance Act 2021. Now, this view, and I'd like to kind of also hear other panelists on this one, is also supported by the CBDT instruction, para 6, does kind of allude to this for uniform implementation of the Supreme Court decision. And just on the aside that the Supreme Court in their order also was cognizant of the fact that the Finance Act 2022 had been enacted. And they chose to explicitly use the words the Finance Act 2021. And therefore kind of seem to say that the Supreme Court's ruling has kind of held that rights are available to obviously to tax officers under Finance Act 2021, but also to say that that 148, 148A, 149 as on the date of issue should be the position in law.
Great, Sridhar, that's very interesting. Mr. Bora, I would like to have your view on this.
Yeah, I think I will supplement what came from Sridhar. You see, the law on the first day of the assessment year will govern the assessment for that year. So when the assessing officer assumes jurisdiction post 1st April 21, it is the law as it stands on that date which will govern or determine the assumption of jurisdiction. So clearly the amendments made by Finance Act 2022 cannot be used by the assessing officer to justify the assumption of jurisdiction. That's one point. Second is, when the assessing officer issues notice, he moves on the basis of law as it stands on that day. A subsequent amendment in law cannot be invoked by the assessing officer to validate jurisdiction assumed earlier in the point of time. So if you look at, I'm just moving a little away. If you look at the Supreme Court judgment in the case of Max, which was on in the context of 263, the Supreme Court said that on the date that the commissioner passed the order under 263, the issue was debatable. There were conflicting decisions. And the Supreme Court noticed that there was a subsequent amendment of law which had retrospective effect, which covered the assessment year under consideration, yet held that notwithstanding the post amendment, although having retrospective effect, that could not cure the defect in jurisdiction. So jurisdiction has to be validated at the time when the assessing officer issues the notice, and it can only be based on the law prevailing on that date.
No, great. Thanks, Ajay. Any other views, Huned, or are you in agreement with this?
No, I agree with what Mr. Bora and what Sridhar has said.
Perfect. Great. Mr. Bora, then just one point that you had also referred to earlier. The Supreme Court has exercised its powers under section Article 142 of the Constitution. So, can you elaborate on the circumstances under which this article is invoked, and is it frequently used for direct tax rulings?
Yeah. In fact, interesting question. The use of Article 142, to my mind, is completely unprecedented. The scope of this article is that the Supreme Court, in exercise of its jurisdiction, may pass such decree or make such order as is necessary for doing complete justice in any cause or matter pending before it. Now, invariably, in tax jurisprudence, it has been said that both parties to the list, the assessee or the department, must be vigilant. So if I suppose file a belated appeal, it is not mandatory that the court will condone the delay. I must show just and bona fide cause. Equally, a delayed appeal or belated appeal by the department may merit dismissal if there are not adequate reasons to justify the delay. So here basically, merely because the revenue slipped in issuing the notices post 1st April 21 to 30th June 21, that's my personal opinion, did not warrant invocation of this special Article 142. But that's how the court has, passed the orders to somehow sustain the 90,000 notices, and I think that was playing on the mind that 90,000 notices will fall by the wayside if the various High Court judgments, and you had multiple High Court judgments.
Yes.
There was one High Court only, Chhattisgarh, which had taken a divergent view. So there was judicial wisdom of as many number of judges sitting across different High Courts, which had come to the conclusion that the reassessment notices could not be sustained, taking into account the extension of time, taking into account the amendment made by the Finance Act 2021. So clearly this is unprecedented. You asked me the question whether this is used in tax jurisprudence. At least I am aware of only one case which is Greenwood Corporation. Incidentally, I was part of the batch of lawyers representing that matter. That is in 314 ITR page 81. And that was an interesting case where the commissioner set aside an assessment under 263. And the assessee, or we as the assessee pleaded that the assessment was invalid because it was passed on dictates of the then commissioner. So you are well aware that if a law is passed on dictates of an authority who is not the authority passing the order, then that clearly order is invalid because it is not based on satisfaction of the authority passing the order. So the Supreme Court said, and then the further argument was that an invalid order cannot be revised under 260. So the Supreme Court accepted this argument that the order was based on dictates, the order was invalid, could not be revised, but said in order to do justice between the parties, we invoke our special powers under Article 142 and direct the assessing officer to frame a fresh assessment for that assessment year. So at least I am only aware of this particular instance where, Article 142 has been used in tax jurisprudence. I may just, if you give me a minute more, I have seen some recent cases where, the Supreme Court has ordered mediation between warring parties. The mediator appointed by the Supreme Court has used Article 142 and said that basis the award or basis the settlement, this will not attract tax incidents in the hands of either of the parties. Now that matter came to me for opinion that whether the tax department will be bound by this mediation or the settlement, which is presumably under Article 142. My view was, again, it will have to be tested. My view was that the tax department is not a party to the settlement. This settlement is not binding on the tax department, notwithstanding that, and the court did not actually pass the order under Article 142. When the Supreme Court endorsed the settlement, they did not use Article 142. It is there as part of the award of the mediator. So it remains to be seen whether the tax department in that case would honor what has been laid down by the mediator as in exercise of powers under Article 142.
Great. No, absolutely. I think so. Very clearly, this is, as you said, unprecedented. And I think it completely agree that it was guided by the fact that so many notices and you needed to give the tax revenue authorities time to, comply. So that was great. Sridhar, coming to you, the Supreme Court in the case of the JKN drive shafts in 2002 had laid down certain principles on Section 148 and reassessments. In your view, do these principles continue to apply in view of the Amendment White Finance Act 21?
Yeah, so just to also step back, we all know that the GKN drive shaft decision required assessing officers to be bound to furnish reasons for reassessment if requested by the taxpayer. It also required the AO to pass a speaking order after giving the taxpayer an opportunity to be heard and after considering the objections raised by him. Now, in the present Supreme Court case, Ashish Agarwal, this case also calls out that there have been several reasons because of which reopening of matters were challenged, resulting in numerous litigations on various grounds, including the procedure laid down in GKN drive shaft itself. Given that those procedures as given in the GKN drive shaft ruling was not followed. Now, the substituted provisions of the Income Tax Act, White Finance Act 2021, no notice under 148 can be issued without following the procedure prescribed under Section 148A. And along with the notice under Section 148, the AO is required to serve the order passed under Section 148A as well. Now, by virtue of the introduction of Section 148A, the procedure is now expected to be streamlined and simplified. And this inter alia provides for the AO to issue show cause notices on the basis of information which suggests that income chargeable to tax has escaped assessment and resulting from an inquiry conducted, if any. Now, these are, there's also, of course, the principle of an opportunity of being heard for an SSC enshrined in the procedure fundamentally laid down in 148A. So, at least my reading of this seems to say that while the principles laid down by the Supreme Court in the GK and drive shaft case may not necessarily be relevant for tax officers to follow the procedure, but obviously the procedure laid down under 148A now becomes the law for them to apply. But the heart and soul of the issue seems to have been addressed by virtue of the section itself, and hopefully that was the intent. And coming to intent, it seems that the department itself wanted to bring out a more structured approach and a procedure in dealing with this process, and therefore anything enshrined in law should kind of prevail. That's my understanding. Happy to kind of hear the panel on this.
Any other views by the panelists?
I can, if
Yes,
if I
please.
want to say something, I can otherwise come in.
Yes, please.
I think the procedure that was enacted pursuant to GT and drive shaft, to my mind, has now been legislatively incorporated in the new provisions. So earlier, the Supreme Court had directed the basis on which the reassessment would proceed. Now, today, this is part of the statute and it is mandatory for the assessing officer. So just to step back, if you recall, the Supreme Court Constitution Bench in Calcutta discount had said that notice under 148 can be challenged in writ proceedings. Thereafter, this was diluted in GK and drive shaft, which was many decades later, where the Supreme Court said that instead of straightaway jumping to the court in a writ petition challenging the notice, you follow this process of first file a return, ask for the reasons, furnish your objections, the assessing officer to dispose the objection by speaking order, and thereafter come to the court in a writ petition if necessary. Now, the same procedure is enacted in the present section 148A in a slightly varied manner, in the sense, and which is, I think, much laudable, where the court says you first issue a show cause notice, you do your inquiry, issue a show cause notice under 148A, and then ask for the reply by the assessing, consider the reply, and then after pass an order under 148AD. So if the assessing officer is satisfied with the response of the assessee, he should drop the proceeding at that stage. So it will not go to a stage where he issues the notice under 148. So clearly, according to me, this principle has been now built into the statute itself. And it is very welcome. It is very welcome.
Great. No, that's a very, very valid interpretation. Thanks, Mr. Bora, for that. Now, coming to some of the practical aspects of reassessments, I'll start with you, Huned. So, first of all, is the procedure under section 148A being handled by the jurisdictional assessing officers or the faceless assessment center?
See, the issuance of the notice under 148 deemed to have now been issued under 148AB. The response, processing the response of the taxpayer and passing of the order under 148A(d). Post issuance of the notice under 148, so the reassessment proceedings would take place by the National Faceless Assessment Center. Currently, up to the issuance of the notice under 148, it is being handled by the jurisdictional layer. There is an advantage in that, is at least you have an opportunity of even personally representing before the AO once you have submitted your response under 148AB. You don't have to wait for a video conference to be granted by the Faceless Appeal Assessment Center to be heard against the show cause notice.
Great. Thanks, Huned. What are the key challenges that taxpayers, in your experience, have been facing post the apex cause decision, with the new process, so in terms of requirement of material and the like?
Yeah, see, the Supreme Court in the order in Ashish Agarwal said that directed the tax officers that within 30 days to provide the information and material on record to the taxpayer. The CBDT took some time to come out with its circular, so therefore again the tax officers did not have adequate time to provide the taxpayers with the information. So what is being seen is that in the issue letter, all that the officers are writing is that the information and the reference to the material which suggests that income has escaped assessment is as per the annexure. And the annexure is just a rephrasing of the earlier recorded reasons. So, the material is not being provided. In many cases, such notices have been received on the 2nd of June, where 3rd of June was the deadline. Now, whether the non-furnishing of the material, would that be a violation of the Supreme Court order by the tax officer? And therefore, if in my case, I was covered by the decision in a writ petition by the Delhi High Court or the Bombay High Court, would I still continue to be covered because the tax officers have not followed the Supreme Court directions? Mr. Vora, your thoughts on that?
I would think if you look at the reported decisions, this is an irregularity of not making that information available. The courts have therefore directed the assessing officer to make the information available, and for the assessee then to furnish a response. Clearly, these assessing officers have erred in not scrupulously complying with the direction of the Supreme Court and also the provision of the statute, where it says that you have to make available that information to the assessee in order to enable the assessee to furnish detailed response. That is one aspect. The second, I think, when you talk of challenges, the other major challenge which is coming and which courts have taken cognizance of is non-application of mind to the response submitted by the assessee. So you have made available the information, the assessee has given a detailed response justifying why income has not escaped assessment. There has to be application of mind on the side of the assessing officer before he passes the order under 148 AD and proposes to issue the notice under 148. So if that is not done, the whole purpose of bringing this procedure in the statute in line with the GTBharat principle will be lost. And that's how this is promoting litigation. If at the end of the tax department there is due application of mind in line with what is enshrined in the statute and in line with what has been advocated by the Supreme Court, I would think it will substantially cut down litigation.
Absolutely. The edifice will collapse, yes. Mr. Vora, then from that, extension of timelines has been at the center of controversies, right? So in your view, did the apex court overrule the TOLA, the Taxation Other Laws Relaxation and Amendment of Certain Provisions Act?
No, in fact, the Supreme Court has not explicitly dealt with that controversy at all. When they invoked their powers under Article 142, I think the controversy no longer remained relevant when they said these notices will be deemed to be notices under Section 148 capital A under the new law. So at the moment, there is no decision with respect to what the High Court had held that the department erred in using the benefit of TOLA to issue notices up to 30th June 2021.
Great. Okay, as a follow-up question under the amended provisions, is prior approval of the specified authority for conducting an inquiry optional in all cases for purposes of Section 148A?
No, are you referring now to the amendment or are you referring to the Supreme Court cases? Those set aside by the Supreme Court.
Right. No, so
set aside by the Supreme Court, clearly that is obviated. That is no longer required.
no, so
Right. Sorry. Go ahead, please.
so I was basically just checking can the AO today simply move to section subclause, clause B of Section 148A without conducting an inquiry?
Not for fresh notices, certainly not.
Yeah.
No, that dispensation given by the Supreme Court is limited to those notices which were issued between 1st April 21 to 30th June 21. It is not a carte blanche to say that in any and every case, we skip the step in 148AA and move directly to 148AB. No, that does not give a handle to the tax department. Certainly not.
Right, that's a fear. Thank you for clarifying that. Sridhar, is the time limit for completion of a reassessment under section 153 calculated from the date of the original notice, which was issued under section 148 under the old regime, or no?
So the way the Supreme Court decision reads is the notices issued by the tax office under the old regime on or after 1st April 2021 are to be regarded as deemed show cause notices as per provisions of 148AB of the Act. And the time limit prescribed for completion of reassessment proceedings as per section 153 is 12 months from the end of the financial year in which the notice under 148 is issued. It's therefore a requirement that the tax law should follow the procedure laid down under section 148A. The AO should follow that procedure and then decide and pass an order concluding as to whether the notice under 148 should be issued or not. And the time limit for issue of notice under 148 is also now provided in 149 itself. So the predominant view seems to be that the time limit under section time limit for section 153 would be determined with reference to the date of the new notice under section 148, with the rider that if at all it is issued by the tax office and not with reference to the notice under section 148 issued during the period between 1st April 21 to 30th June 21, which are now deemed to be show cause notices under the new regime. That's my reading.
Great. Thank you. Hunit, coming to writs, what are the recent issues in reassessment cases being taken up, which you have been party to, which have been initiated based on this ruling? And are there any rulings? So what is the trend of the court on?
As currently, even as Mr. Vora pointed out, the challenge being faced by the taxpayers is the non-application of mine before passing the order under 148 AD. I think there are several decisions on that where the High Courts have directed the assessing officer to pass a speaking order and with the application of mine on the response filed by the taxpayer. So that is one of the issues which is being drawn up in the writ. There are several there are hasty orders being passed under 148 AD. They have 30 days to pass an order from the receipt of the assessee's response, but it is seen that they are passing it within a very short period after, and again without due application of mine. The other thing is non-granting of adjournments when they are asked for by the taxpayer. So these are the issues which are right now coming up in the recent past on the writ on the reassessment procedure.
Mr. Vora, this is exactly your domain. So in your experience, in what situations do you think taxpayers should explore writs for under these reassessment provisions? And do you think also as a follow-up, maybe I can ask, that do you think that there's any merit in exploring writ option after the recent case of Gian Castings?
So far as the first point is concerned, I'll add to what came from Hunit. You see, the Supreme Court in this Ashish Agarwal judgment had said that the defenses available under the old law are still available. So section 149 to 151 is still available. So it's an open question whether reassessment for assessment years 13, 14, 14, 15, which we saw, and 14, 15, which would normally have become barred by limitation on 31st March 51, before the new law, are saved by the judgment of Ashish Agarwal. So that's an open question which is going to engage the attention of the courts. and clearly one had expected that the CBDT would have thrown light. They have said that if the amount of income escaping assessment is less than 50 lakhs, even if it is represented by an asset, then those cases will not survive post Ashish Agarwal. But I would tend to take the view that one can still challenge these on the grounds that the notices are barred by limitation.
Okay.
Now, to answer your second point about the Supreme Court recent decision and dismissal of SLP in Gyan's case, you see, the writ jurisdiction is a discretionary remedy. Article 226 is an extraordinary remedy that is provided where you approach the court where the proceedings are without jurisdiction. So, on the basis that the order under section or the notice under section 148 is issued without jurisdiction, you can, file a writ petition in the court seeking to challenge the initiation of proceedings and the issue of notice under section 148. As I said, this is discretionary. This judgment that the Supreme Court rendered in the SLP was basis a decision of the Punjab Haryana High Court. Now, Punjab Haryana High Court of late has been taking a view that you have an alternate statutory remedy of going up in appeal after the reassessment order is passed, where you can raise all these contentions, including the legality of the reopening of assessment, and therefore you need not come to the court invoking the writ jurisdiction of the court. But I think that's an isolated instance that has happened. I have a judgment from the Punjab Haryana High Court where they did intervene and pass an interim order staying the proceeding. That was, of course, under the old law, but they did deal with the matter. Delhi, Bombay, consistently the courts are interfering in exercise of their writ jurisdiction. And the dismissal of the SLP is not declaration of law by the Supreme Court. So merely because the SLP stands dismissed does not mean that the doors are closed for approaching the High Court under Article 226. So you have to weigh this, you have to weigh the issue of approaching the High Court in a writ petition basis a cost-benefit analysis, in the sense that you approach the court and you also weigh the relative merits and the probability of succeeding and getting an interim order, versus going through the rigmarole of having an assessment, going up in appeal, first level, second level, High Court, Supreme Court. So if you succeed in the writ petition, you nip the issue in the bud. So I think that's a call that each assessee, each client needs to be taking vis-a-vis the relative merits, demerits of their case and the cost-benefit analysis.
Absolutely. Great. That's very well put. I can't resist closing this without putting you in a spot, Mr. Vora. So, in summary, do you think the new reassessment regime meets its object and purpose or not?
I would say that the law as it is framed has been enacted with a very laudable intent. The idea is to curtail the time limit, provide finality to proceedings, reduce litigation. I think there can be no dispute, no quarrel that it has been brought in with the right intent. The only question is the implementation. You see, if you, toward the end of the financial year, issue a spate of notices, then in that situation, you are frustrating the purpose for which the enactment was brought about. I can tell you that, speaking from experience, the Delhi High Court was frustrated with the number of matters that were coming before the court on a daily basis. We had, in the judgment that was reported, Manmohan Kohli, it was a batch of over 2,000 plus matters. Then there was another batch of matters created where the notice presumably was dated 31st March, but issued beyond 31st March in the sense that the email was sent after midnight of 31st March. So all these cases are now the current trend of cases that are coming because the assessing officer either has not given you reasons or has not applied mind while disposing of your objections. If this trend continues, then the purpose will be lost. Then I think the enactment or the amendment will not meet its laudable objective.
So you think the heart is in the right place now, behaviors have to follow.
Right. In fact, I think the implementation is what is leaving much to be desired.
Right. No, great. This has been very, very interesting and interactive debate. Thank you very much to all the participants. We could go on, but we are totally out of time. As far as everybody who's seeing it, if there are any questions in the question box, we will get back to you by email. Thank you very much for attending, and thank you very much, Mr. Vora, Sridhar, and Huned, for sharing your thoughts. Thank you.
Thank you so much. Thank you, guys.
Thank
Thank
you.